Welcome to JK Shah classes. We are conducting revision lectures for all students who are pursuing intermediate course or IPCC course. Let's go on for our next accounting standard, that is AS11, accounting for changes in foreign exchange rates. Now, what is this standard all about? This standard is all about learning how to account for exchange rate differences. The points which I am going to cover here: scope, terms, foreign currency transaction, the way we are going to account for foreign currency transaction, then para 46 or 46A, foreign operations, and forward contracts. These are the points which we are going to discuss as far as AS11 is concerned. Let's start with the first area, that is scope. As far as scope is concerned, the standard does not apply to translation of financial statements in the currency of the user. So, my investor is an Australian person. I prepare my financial statements in Indian rupees. So, my Australian investor wants that this financial statements be prepared in Australian dollar, his currency. So, what are the principles? What are the rates to be applied for converting a balance sheet, an income statement, a cash flow statement from rupees to Australian dollar? This area is not covered by AS11, translation of financial statements. Second, currency fluctuations. To the extent they are regarded as borrowing cost. If you remember, in AS16, we have one paragraph, para 4E, which talks about this area, currency fluctuations, where we find out what is the impact of difference in interest rate, and because of difference in interest rate, something is referred as borrowing cost. This is not covered under AS11 because it is covered by AS16. Same way, presentation of exchange difference in a cash flow statement is also not covered by AS11. Coming on to the next area, that is some terms. Now, simple terms, what is local currency? So, the currency in which financial statements are prepared. Then comes, what is foreign currency? I can just say other than local currency. All currency are referred as foreign currency. What are monetary items as per AS11? They are nothing but items of which the amounts are fixed or determinable. Example, debtors, loans, creditors, bills receivable, bills payable. Their all amounts are determinable. Non-monetary items. The amounts are not fixed or determinable. Example, fixed assets, investment inventories. The amount is not fixed. If I want to dispose of a fixed asset, how much would I realize? The amount is not fixed. So it's a non-monetary item. Of course, there are few more terms: opening rate, rate, exchange rate at the beginning of the year, closing rate, exchange rate at the end of the year. Average rate is nothing but average for a particular period. If it is yearly average, opening average rate plus closing average rate divided by 2 and so on. So I'm not going in depth of that. I just directly come upon foreign currency transactions. Now, what do I mean by this? Here we are going to talk about how these transactions are to be recorded, are to be recognized as per AS 11. Like, let me just give you an example. Purchase goods worth rupees. I'll say not rupees because worth $10,000 on 1st Jan 2019. Paid $6,000 on 25th of February 2019. Paid $4,000 on 8th of April 2019. The exchange rate is as follows: $1 equals 60 on 1st of Jan, $1 is 63 on 25th of February, $1 is 61 on 31st of March, and $1 is 64 on 8th of April. Now, because our local currency is rupees, the currency in which we prepare our financial statement is rupees, we are going to convert this transaction and recognize at Indian rupees. Like when you purchase goods, I'll say on 1st of Jan, if I'm purchasing goods, my entry is purchase account debit. Of course, the creditors who are in foreign currency, 10,000 into 60. There is nothing but 6 lakhs. Then I can say this is $10,000 into 60 rupees. Then on 25th of February, I'm paying. But when I'm paying, the rate is 63. The rate is 63. So what is to be done for this? So 60 is 63. So there is a loss of 3 rupees because I have to buy dollars at 3 rupees. I have to pay 3 rupees extra. I mean to say I have to buy dollars at 63. So I have to pay 3 rupees extra. On how much? So you'll say only on 6,000. So I'll say exchange fluctuations exchange fluctuations account debit to creditors. I'm paying only $6,000, and for each dollar I'm paying 3 rupees extra. That is nothing but 18,000. This is on 25th of February. On the same day, I have to make a payment, so my entry is creditors account debit to bank. There is nothing but $6,000 into 63, which gives me 3,78,000. This is referred, this area. Exchange fluctuations. These are our exchange fluctuations. It may be a loss, it may be gain. Like instead of 63, I would have something which is less than the 60. Then it would have been gain because I have to pay less amount in rupees to get that much dollars. Proceeding further, now what happens on 31st of March? If you look properly, my creditors now are standing out of 10,000 into 60. Can I say 6,000 have already been settled? So I'm left out with 4,000. 4,000 are now getting recognized only at 60 because that was nothing but initial recognition rate. For the first time, when I recognize it, it is referred as initial recognition rate. And this was nothing but 63 was my settlement rate. And the difference between a settlement rate and initial recognition rate is nothing but exchange gain or loss. Now, on 31st March, I want that creditors to be shown at closing rate because that is the actual amount payable to creditors. So when I say I want to show my creditors at closing rate, I need to increase my creditors. I'll say exchange fluctuations debit to creditors. There is nothing but 4,000 into 1 rupees. Now how did I get this 1 rupees? It was 60, now it is 61 on 31st of March. So 1 rupees is my loss. So I'll say it is nothing but 4,000 is my loss. One more entry I need to pass on 31st March. That is nothing but transferring the exchange fluctuations to P&L, profit and loss account debit to exchange fluctuations. That is nothing but 4,000 plus 18,000, 22,000 is my total loss arising due to currency changes. Now you can also have a gain here. Instead of 61, this would have been 51. Then 9 rupees is the gain. इसकी जगह पे 51 होता था तो 9 रुपये का gain होता था. हाँ? So then 9 rupees into 4,000 would have been 36,000 here. Now this is the end here for the current year, that is current financial year. I end, that is 18-19. Now what will happen in 19-20? Can I say I have paid some $4,000? So on 8th of April when I pay $4,000, now if you look properly, you will not compare 60 and 64 because you have brought the remaining amount from 60 to 61. यहाँ पे आ गया है. So now 61 has become 64. So there is a loss of 3 rupees again. So I'll pass an entry, exchange fluctuations. Account debit to creditors $4,000 into rupees 3. That is nothing but 12,000. And then same on 8/4, I'll pass an entry, creditors account debit to bank $4,000 into the rate is 64. Which gives me 256,000. Now if you look properly, your creditors account tallies. $6 lakhs plus 18,000 minus 378 plus 4,000 plus 12,000, and we end up paying 256. Now what is happening is, creditors being a monetary item, the exchange fluctuations affecting my monetary item. Because I can determine the value, amount is determinable. Due to exchange fluctuation, the amount is determinable with respect to creditors. So one hit is going in exchange fluctuation, the other is going in my creditors. Remember, due to exchange fluctuation, the effect is always on monetary item and not on non-monetary item. I have purchased goods, but that does not mean my inventory value will be increased by this exchange fluctuation. What will be increased will be nothing but my creditors only. Yeah. So monetary items do get affected due to exchange fluctuation. Non-monetary items remain where they are. My goods will always be shown in the books at 6 lakhs rupees. Instead of goods, I would have purchased a fixed asset. Then also fixed asset account debit to creditors either would have been the same. Then there is exchange fluctuation. Then also the effect will only be on creditors and not on the fixed asset. In a nutshell, I can say that if I apply normal AS 11 principles, then all exchange fluctuations, whether they are favorable to me or unfavorable to me, will always go to profit and loss account. AS 11 says that all exchange fluctuations will always go to profit and loss account. But if the entity has chosen to apply this paragraph of AS 11, then there would be a difference. Now what does this paragraph, para 46 and 46A mean? Now as far as para 46, 46A is concerned, I would say it is nothing but an alternative accounting treatment for exchange fluctuations. It is not at all compulsory. It is alternative accounting treatment for exchange fluctuation. Now what it says? It says if there is an exchange fluctuation with respect to foreign currency monetary item, in relation to a depreciable fixed asset, the standard had given something known as capital asset in relation to a depreciable fixed asset or in relation to others. Then what is to be done? If it is in relation to depreciable fixed asset, then exchange fluctuations will be added to the asset. Very important. It will not go to P&L. Exchange fluctuation will be added to the asset. And if it is in relation to others, means you didn't had a depreciable fixed asset, you had borrowed some loan, but not for a fixed asset, but for some other purposes, and there is an exchange fluctuation, then here it says exchange fluctuation will be transferred to don't pronounce it, it's a short form, foreign currency monetary item translation difference account. Repeat, foreign currency monetary item translation difference account and amortized. Now, I will again speak upon this, will again revise this important para 46, 46A. Now, what do you mean by para 46, 46A here? This is alternative treatment with respect to currency fluctuation, exchange fluctuation for foreign currency monetary item. Now, what do you mean by foreign currency monetary item? So, here they say that item should be there for a period of at least 12 months. Means any monetary item, maybe a loan taken or creditors or a debtors, whichever is the monetary item, that monetary item should be there for a period of 12 months, then only this para 46 will be applicable. Otherwise this para 46, 46A is not at all applicable if you don't have a foreign currency monetary item. So what is a foreign currency monetary item? A foreign currency monetary item is an item which stays in the books for a period of 12 months. Which stays in the books for a period of at least 12 months, then only. So the example which I did here above, is this creditor a foreign currency monetary item? Answer is no. Why? Because it originated on 1st of January and expired in the sense and got paid off on 8th of April, that is just within 3 months. So this is not a foreign currency monetary item. So don't think about applying para 46 in this question. You cannot apply para 46. It has to be a long-term item only, monetary item. Means para 46 will be applicable for borrowings. If you have borrowed in foreign currency, that too for a longer period of time, and this borrowings you have made for what? You have made for a fixed asset which is depreciable, or others, you have made a borrowing for others, non-depreciable asset. Then the borrowings which is in foreign currency has to be restated at the closing rate. So obviously there will be exchange fluctuation. You took a loan. If you took a loan, say $10,000 loan for 5 years, when you took the loan, it was 50. After 1 year, it is 60. So now this loan is a monetary item. 10 rupees is the exchange fluctuation. And of course, it is a long-term monetary item. So this 10 rupees, what should be done of this 10 rupees? The first option is debited to P&L account. But there is an alternative treatment by para 46, which says, if you have taken the loan for this fixed asset, then this 10 rupees should not be debited to profit and loss account, but will be added to the cost of that asset. But if you have taken this loan, not for a fixed asset, but for some other purpose, working capital or whatsoever it may be, then in relation to others, then the exchange fluctuation of 10 rupees, only if you apply para 46, then this exchange fluctuation of 10 rupees should be transferred to one account known as FCMITDA, that is Foreign Currency Monetary Item Translation Difference Account, and amortized. Of course, both para 46, 46A is one and the same. They were all made applicable from different dates. That's why we have both of them, but one and the same thing. Yeah. Now, the most important. If you apply para 46 or 46A, then para 4E of AS16 not applicable to you. Means you need not do the working as per para 4E of AS16. Yeah, here we had a scope. In the scope I had clearly mentioned that something will be covered only by that. That exchange fluctuation is to be covered by AS16 only. But if you are applying para 46, not a single exchange fluctuation will be covered by AS16. It will only and only be para 46, 46A. Now we move to the next area of our discussion. If you look properly, we completed scope, terms, foreign currency transaction along with para 46, foreign operations. Basically, foreign operations you'll be learning more in branch accounting, then also to give you a just normal idea with respect to it, what should be done. So what is a foreign operation? Foreign operation is either a branch, a subsidiary, associate or joint venture, the activities of which are carried out in a country other than reporting country. That is your foreign operation. So I have a branch in South Africa, I have a branch in Bahrain, I have a branch in US. There is nothing but a foreign operations. So now if I have a foreign operations, this foreign operations will obviously prepare its books of accounts in their local currency. So if it is in US, it will prepare its books of accounts in dollars. If it is UK, then it will prepare its books of accounts in pound and so on. So now the books of accounts are prepared in other currency. I have to incorporate those financial statement in my books. The head office in India, in Mumbai, has to incorporate the financial statements of a branch which is in US in India. For that, how should it be done is given by AS11 in foreign operations. Of course, AS11 says a foreign operations can either be an integral foreign operation or it can be a non-integral foreign operations. An integral foreign operation is an integral part of the reporting enterprise. It is extension of your existing activities. Whereas when I say non-integral foreign operation, other than integral foreign operation, all foreign operations are non-integral. The standard talks all those things. It accumulates cash. It takes loans. It deals in its own currency as well as other currency. That is nothing but non-integral foreign operations. Now, what do you mean by integral and non-integral? That is okay. But what is the main part of the standard? Standard says what are the exchange rates to be applied for translation, because they have prepared, the branch has prepared the books of accounts in their currency, and just abbreviate IFO NFO. Branch has prepared it's in its own currency, and I need to find out Indian currency way. That branch says we have fixed a set of $5 lakh. So I'll say, okay, $5 lakh. It means in India, if I want to show this fixed asset, at what rate should I say? Should I say $5 lakh only? I have 50 lakhs rupees of asset plus $5 lakh of asset. Obviously, no. I have to convert. That is nothing but translate this $5 lakh into my local currency. So at what rate? So it all depends. Like, if it is a monetary item, closing rate. Non-monetary item, historical rate. For NFO it is closing rate. Some incomes or expense and all those things. For incomes and expense, basically the standard says actual rate, but we go with average rate, because you have to find out actual rate at every point of time, which is not that much practical to do. Mutual indebtedness and transactions. So head office has sold goods to branch and branch has sold goods to head office. They are debtor and creditor within themselves. So what is to be done for that? The standard says for both of them not to be translated at any exchange rate. Means you should not use any exchange rate, but substituted with the amounts appearing in the books of head office. Now, what is to be done for exchange difference? This you will do more in a branch account. There we have problems also. So you may go through our branch account revision lecture where we have problems and all those things with respect to this. What is to be done for exchange difference? The standard says difference means the difference in trial balance what arises. It says debited or credited to profit and loss account. If it is NFO, we transfer it to FCTR. That is, FCTR is nothing but foreign currency translation reserve. Yeah. Exchange difference. Why do we have exchange difference? Because my trial balance was in dollars. I converted it using different rates. Closing, historical, average. Something I didn't convert in only. I substitute. I say HO ka books mein jo amount hai rupees mein, same amount likh do apna branch mein. So I didn't translate only. So obviously there will be a difference. Instead of saying exchange difference, I should use the word resulting differences in trial balance. That is better. Resulting difference in trial balance. Debit or credit to profit and loss or transfer it to FCTR. Now, this is what we learnt about our foreign operations. Yeah. So foreign operations done. The last area, that is forward contracts. Now, how this forward contracts have to be accounted as per AS 11. It says forward contract can be for the purpose of hedge or speculation. Now, what do you mean by forward contract? Forward contract is a contract to exchange foreign currency on a particular date at a particular rate. I'm insuring myself, I'm insulating myself against the changes which may be against me. Like I'm going to receive $10,000. Now there is a risk. After 3 months, $1 will be how much? Or I have to pay $8,000. So there is a risk that after 3 months, how much will be $1? I have to buy it afterwards or I have to sell that dollar afterwards. Dollar or any foreign currency. So I would like to protect myself against the changes in foreign exchange rate. How to protect myself? I can enter into a forward contract. So what is a forward contract? Forward contract is a contract entered today to exchange foreign currency on a particular date at a particular rate. That is nothing but a forward contract. Now this forward contract is done for the purpose of either hedging or speculation. Now if it is hedging, means I want to protect, I have receivable or payable, so I enter into a forward contract. So it says hedging. I neither have a receivable nor have a payable, then also I enter into a contract, then it is referred as speculation. I want to make money from changes in exchange rate. Now what is the recommendation of the standard? As far as hedge is concerned, it says difference between spot rate. Now what is the spot rate? The rate available today. The day I am entering into that forward contract, whatever is the exchange rate. अगर मैं आज $1 खरीदता है तो $1 कितने में पड़ेगा? $1 is 60. So that is nothing but my spot rate. Exchange difference between spot rate, there is difference between spot rate and forward rate. But if I tell you, I don't want to buy it today, I want to buy it after 1 month, will you say 60? You will say, no sir, it is 62. So the difference between spot rate and forward rate is referred as premium or discount, and to be amortized over the tenure of forward. So if your forward is for 6 months, 3 months in current year, 3 months in next year, so whatever is the difference, maybe premium or discount, beneficial or not beneficial, whatsoever it may be, that will be transferred to my P&L account in the ratio of 1:1, because 3 months in this financial year, 3 months in next financial year. समझो forward contract is for 4 months, 3 महीना इधर है, 1 महीना next है. So whatever is the forward premium or discount, 3 months का expense or income will be in this P&L, 1 month will be in the next P&L. Yeah, hedge, this is to be done. As far as speculation is concerned, no need to recognize premium or discount. It is always mark to market. It is always mark to market. No need to recognize premium or discount. It is always mark to market. Mark to market means what? आज ये कॉन्ट्रैक्ट का वैल्यू कितना है 31st मार्च को, that is referred as mark it to market. Yeah, so as far as speculation is concerned, no premium or discount will get recognized. As far as hedge is concerned, premium and discount will be recognized in our books. Clear? So this is where we end our AS11 explanation. Let's now proceed to solving some questions and answers on AS11. I repeat, these questions and answers will also be available on our website jkshaclasses.com. So, the first question. BK Limited purchased fixed asset costing 5,000 lakhs on 1st April 2012, payable in foreign currency on 5/4/2013. Exchange rate 54.98 on 1st April 2012 and 31st March 13. The company also obtained a soft loan of $1 lakh on 1/4/12 payable in 3 installments. First installment was due on 1/5. You are required to state how these transactions would be accounted in the books of for the year ending on 31st March 2013. Now, if you look properly, it's a basic transaction. When they say 5,000 lakhs, this 5,000 lakhs is divided by 50. It means I have taken somewhere around 100 lakh dollar. I have purchased an asset which is 100 lakh dollar on 1st April 2012, and the amount is payable when? It is payable on 5/4/2013. It means I have a fixed asset, and against this fixed asset there is a creditor which is to be paid on 5th of April 2013. Now let's talk only to this much part. The remaining part we'll do later. Now can I say this 100 lakhs dollar will be recognized at initial recognition rate, that is 50. After 1 year, that is on 31st of March, it is 54.98. So can I say there is a loss of 4.98 per dollar, loss of 4.98. It means the total loss is 498 lakhs. Now what is to be done for this 498 lakhs? You have two options. First option, if you are applying normal paragraphs of AS11, this 498 lakhs will be debited to profit and loss account. But if you are adopting para 46A, which we learned here itself, para 46A, then the exchange fluctuation will be added to the cost of the asset. So this 498 lakhs and this 100 lakhs, 498 lakhs will be added to the cost of that fixed asset, because you have a foreign currency item for a depreciable asset. Coming on to the second part, the company obtained a loan 1 lakh payable 3 installment, first installment 1/5. If you look properly, both of them, whether it is creditor or it is a loan, both of them are completing a period of 12 months. Both of them are completing a period of 12 months. Now if they're completing a period of 12 months, means they are having an option to apply para 46. Now here also, $1 lakh on 1st April 2012, so it is still 1 lakh and 54.98. So what is to be done here? Can I say $1 lakh into 4.98? Because it's same rate, 50 will be there and 54 point. So I will have 4.98 lakhs exchange fluctuation, two options. If I'm applying normal principles of AS11, then this 4.98 lakhs will be debited to my profit and loss account. But if I'm applying para 46 or 46A, this will be transferred to FCMITDA, foreign currency monetary item translation difference account, and will be amortized. So you have to give both the answers, that you can either debit it to P&L if you're applying normal provisions of AS11, or if you're applying para 46, 46A, it will be transferred to FCMITDA. Yeah, so this is what the brief idea of para 46, 46A has been given here. So exchange difference 498 lakhs will be capitalized. Here it will be transferred to FCMITD. Of course, Last is A account. First, just read transaction number 1. Then we go for transaction number 2. Yeah. So now let's move to the next part. Next question. Sterling Limited purchased a plant for US $20,000 on 31st December, payable after 4 months. The company entered into a forward contract for 4 months at 48.85. Now, if you look properly, now you are buying the goods on 31st December when the exchange rate is 47.50. This is nothing but my spot rate, the rate available on the date of transaction. And I'm entering into a contract to buy the dollars at 48.85. Can I say this is nothing but my forward rate? This is nothing but my forward rate. So what we are going to do, difference between the forward rate and spot rate, that is nothing but 48.85 minus 47.5. That is nothing but 1.35 into 20,000. That is 27,000 rupees is my forward premium. This is my forward premium. I have agreed to buy something at higher rate as compared to the spot prevailing. So this forward premium, this 27,000 is my expense. This expense is for the year December, January, February, March. Not December, I'm sorry. This expense is for the period January, February, March, April, because it is 31st December. So Jan, Feb, March, April, it's 4 months. So can I say out of 27,000, I will say 3 by 12 will be in the current year, 1 by 12 will be in the next financial year. I'm sorry, it's not 3 by 12. It's 3 by 4 and 1 by 4. 4 months total forward premium is the contract is there, out of which 3 months is for this, 1 month is for next year. Extremely sorry, I spoke of 12 months. It's not 12 months, it's 4 months. So out of total 4 months forward contract, 3 months are falling in the current year, 1 month is falling in the next year. So 27,000 into 3 divided by 4. The amount of forward premium which will be debited in the current year is 20,250, and the amount of forward premium which will be debited in the next year is 6750. Yeah, so this is our answer here. You can just go through it. Yeah, forward rate, spot rate, so 1.35. So your total is 27,000, 4 months, 20,250 in the current year. The balance will be in the next financial year 6750. B part. Goods purchase 45, exchange rate 44, date of actual payment 43. So how would you take care of this? When you purchase goods for 45, now it is 44. So there is nothing but an exchange gain of 10,000 to be recognized. When you actually make a payment, there is again a gain of 1 rupees per dollar. That is 44 has become 43. Again a gain of 1. So it's nothing but 10,000 gain to be recognized for the year ending on 31st March 2011. That is in 10-11 there will be a gain of 10,000 rupees. Similarly, there will also be a gain of 10,000 rupees for the next financial year, that is 11-12. Yeah, so gain of 10,000 rupees. Next also there is a gain of 10,000 rupees. We move to the next question. Mr. Y bought a forward contract for 3 months at 2 lakhs on 1st December when $1 was 44. I'm sorry, 2 lakh on 1st December at $1 44. This is nothing but forward rate when the exchange rate was 43.90. So this is nothing but my forward rate. This is nothing but my spot rate. On 31st December, when he closed his books, the exchange rate was 44.20. On 31st January 2011, he decided to sell the contract at 44.30. Show how profits from the contract will be recognized. Now, first of all, we can come on a conclusion that this contract is not in the nature of hedging, but it is in the nature of speculation. You will say, how did you come to know it is speculation? The reason is very simple. Nowhere it is mentioned in the question that I have entered into a forward contract because I have receivable or payable. Of course, here you have bought the contract. It means you should have payable. There should be some creditors to whom I have to pay foreign currency, but there are no creditors. So nothing to worry about. We will always mark it to market. Now when I say market to market, this was the rate at which I have bought. Now 44.10 becomes 44.20. Yeah, I've agreed to buy at 44.10. Everybody will buy at 44.20. So can I say I'm making a profit of 10 paise per dollar on 31st of December? I'm making a profit of 10 paise per dollar. Now how did I get this profit? I will enter where I'm buying at 44.10. I'm buying at 44.10. Today on 31st December everybody will buy at 44.20. But obvious I will sell at 44.20 just for understanding. So I make up a profit of 10 paise for financial year. Of course 10 paise into $2 lakh. That is 20,000. This is nothing but profit which is there for the financial year 2010. In 2011, when I actually sell off the contract, I sell the contract at 44.30. Now if you look properly, from 44.10, I have already booked 44.20, and from 44.20 I am coming to 43. Now why did I book at 44.20? ये profit क्यों लिख लिया? Because मेरा year end हो गई. My year has already ended, and because the year is ended, I am booking a profit of 10 paise. Now already I have booked a profit. Now 44.30, then can I say it is still a profit, because now this is my revised buying rate. This becomes my selling rate. Again a profit of 10 paise on 2 lakhs. That is nothing but 20,000 is the profit. Yeah, this is forward in the nature of speculation. So no premium or discount will be recognized. Speculation. Profit is 0.20, but this 0.20 is in two parts. Total contract profit is 40,000. This two parts. Current year 20,000, next year 20,000. We move to the next question. STEM Limited purchased a plant on 30th November 2013, payable after 6 months. The company entered into forward contract for 6 months at $62.15. On 30th November, the exchange rate was 60.75 per dollar. Okay. How would you recognize profit and loss on forward contract? I think it's just a repetition. Yeah. 62.15 minus 60.75. So it is nothing but 1.4. 1.4, nothing but forward discount is there. This 1.4 into how many dollars we have? 30,000. So forward discount total is 42,000. See, remember, this is nothing but your forward rate. This is nothing but your spot rate. Difference between forward and spot rate is referred as forward premium or forward discount. If forward rate is more than spot rate, we say forward is at premium. If forward rate is less than spot rate, we say forward is at discount. In this case, what is happening? Forward rate is 62.15, spot rate is 60.75. So can I say it is nothing but forward premium? Forward premium how much? Forward premium total amount is 42,000. 62.15 minus 60.75 multiplied by the total transaction 30. This 42,000 is to be amortized. Now, amortize. In how much period? 6 months from here. Look here, 6 months. It will be amortized in 6 months. Now when I said it will be amortized in 6 months, November is the date of transaction, 30th November. So December, January, February, March. 4 mahina will come for financial year 13-14. So for 13-14, I will say 42,000 into 4 by 6. And remaining will be nothing but 42,000 into 2 by 6. This will go in the next financial year, that is 14-15, and this is in 13-14. Kindly check out your answers. Yeah. It is suggested that you always write the solutions in this manner. Yeah, better presentation. This is just for your understanding purpose, being a revision lecture. I'm just giving you an idea by writing all these ways, but kindly make a solution in a much structured manner. Let's move to the last transaction. Question. Briefly, the accounting treatment needed in the following cases as per AS 11 as on 31st March 15. Debtors include receivable from Umesh 5 lakhs recorded at the prevailing exchange rate on the date of sale of transaction, that is 58.50. So can I say 5 lakhs divided by 58.50, it is nothing but somewhere around 8547.00 dollars, 8547 something dollars. Long-term loan amounting to 60 lakhs, it was recorded at 55.60. So long-term loan 60 lakhs divided by 55.60, which gives me 107,913.67, something like this. This is what it was recorded, yeah, on the date of transaction. On 31st March, it is 61.20. Very simple. If it is debtors, it is neither a long-term monetary item. Yeah, it's not a long-term monetary item. It means normal principle of AS 11 will apply, and whatever is the exchange difference, that is 58.50 or 61.20 में जो भी difference है, that is nothing but our exchange difference debited to profit or loss account or credited to profit and loss account. But ये जो long-term loan है, this long-term loan में दो options आएगा because it completes a period of 12 months, assuming it's a long-term. तो either debit or credit to profit and loss account, the exchange difference being 55.60 and 61.20, debit or credit to profit and loss account. But if I apply para 46 or 46A, then this long-term loan ka jo bhi exchange difference will be there, it will be transferred to foreign currency monetary item translation difference account, FCMITDA. Yeah, so it's again a revision of that stuff. Debtors, very simple, it was 5861, will go to P&L. Credit your P&L by 23017. Long term, it goes to FCMI TDA or goes to profit and loss. I'll repeat this, all solution sets as well as question sets will be available on our website. You can download it from there.